Welcome back to XRP On Moon, the channel where we break down the biggest XRP developments, market signals, and institutional moves shaping the future of digital finance. And today's topic is something that's been exploding across the crypto space with a level of urgency that simply cannot be ignored. Right now, there are reports and data trends suggesting that millions of participants, potentially up to 44 million people, are actively buying or accumulating XRP. And whether that number is exact or part of a broader estimate, the underlying signal is what truly matters. We are witnessing a surge in global attention, a spike in wallet creation, and a noticeable increase in on-chain activity that indicates one thing very clearly. Interest in XRP is accelerating at a pace that is far from normal. This is not just retail speculation anymore. This is coordinated momentum building across multiple layers of the market. Now let's break this down in a realistic, analytical way, because hype alone does not move markets at this scale. When you start seeing numbers like tens of millions of people entering a specific asset class, you have to look at the infrastructure behind it. What's happening on exchanges, what's happening in liquidity pools, and more importantly, what's happening behind the scenes with institutional positioning. XRP has always been positioned differently compared to many other cryptocurrencies because of its connection with cross-border payments and its association with Ripple Labs, a company that has spent years building relationships with banks, governments, and financial institutions. So when adoption spikes, it's not just about retail FOMO. It often signals that something deeper is unfolding. Another critical factor to understand is timing. Markets do not move randomly, especially not when large volumes are involved. The current surge in XRP accumulation appears to be aligning with broader developments in the crypto regulatory landscape, particularly following the long-running legal battle between Ripple and the U.S. Securities and Exchange Commission. As clarity begins to emerge, confidence returns, and when confidence returns, capital flows in. This is basic market psychology, but on a much larger scale. Investors who were previously uncertain are now re-entering, and new participants are entering for the first time, creating a compounding effect that drives both price action and visibility. At the same time, social sentiment and digital engagement metrics are reinforcing this narrative. Search trends related to XRP are climbing, social media discussions are increasing, and influencer coverage is intensifying. These factors may seem secondary, but in today's digital market environment, they play a major role in amplifying awareness. When millions of people begin talking about an asset simultaneously, it creates a network effect that can accelerate adoption faster than traditional financial systems ever could. However, it is important to separate noise from signal, because not all attention translates into sustainable growth. And what makes this situation even more interesting is the structural positioning of XRP within the broader crypto market. Unlike assets that rely purely on speculation, XRP is tied to a specific use case: fast, low-cost international transactions. This gives it a narrative that institutions can align with, especially in a world that is increasingly focused on efficiency and digital transformation. If even a fraction of those 44 million participants are long-term holders rather than short-term traders, the impact on supply dynamics could be significant. Reduced circulating supply combined with increasing demand is a formula that historically leads to upward pressure on price, although the market rarely moves in a straight line. But here's the key point that most people overlook. Large-scale accumulation phases often happen quietly before major moves become obvious. By the time the average investor fully realizes what is happening, a significant portion of the move may have already occurred. This is why data, timing, and context matter far more than headlines. The idea that millions are buying XRP right now should not just trigger excitement, it should trigger analysis. Because in every major crypto cycle, there is always a clear distinction between early positioning and late reaction. And right now, the data is starting to suggest that XRP may be transitioning from a quiet accumulation phase into a more visible expansion phase. When you look closely at wallet distribution patterns, exchange outflows, and long-term holding behavior, a pattern begins to emerge that aligns with what historically precedes strong market movements. This is not about blind optimism. It's about recognizing the signals that often appear before momentum becomes obvious to the majority. One of the most important dynamics at play here is supply pressure. Unlike traditional assets, cryptocurrencies like XRP operate in a transparent environment where large movements can be tracked. Over recent periods, there has been a noticeable trend of XRP being moved off exchanges into private wallets, which typically indicates accumulation rather than short-term trading intent. When assets leave exchanges, they are less likely to be sold immediately, effectively reducing available supply in the market. Now combine that with increasing demand, driven by both retail participants and potential institutional interest, and you begin to see why this moment is being closely watched by experienced investors. At the same time, the role of Ripple Labs cannot be ignored in this entire equation. Unlike many crypto projects that rely purely on community-driven hype, Ripple has spent years building real-world utility through partnerships and financial infrastructure. This creates a foundation that supports long-term narratives rather than short-term speculation. If adoption at the institutional level continues to expand, even gradually, it adds a layer of credibility that attracts a different class of investors, those who are not just looking for quick gains, but for assets that could play a role in the future of global finance. This shift in investor profile is often what transforms a trending asset into a sustained market leader. Another factor contributing to this surge is the evolving perception of regulatory risk. For a long time, uncertainty surrounding XRP limited its accessibility and discouraged broader participation. However, as developments unfold involving U.S. Securities and Exchange Commission and Ripple, the narrative has started to shift. Clarity, even if partial, tends to unlock sidelined capital. Investors who were previously hesitant begin to reassess their positions, and new entrants feel more confident stepping into the market. This creates a feedback loop where increased participation drives visibility, and increased visibility attracts even more participants. What's also interesting is how this momentum is being amplified by global market conditions. In times of economic uncertainty or currency instability, alternative financial assets often gain traction as people look for diversification and protection. XRP's positioning as a fast and efficient cross-border payment solution gives it relevance beyond just speculative trading. It becomes part of a larger conversation about how value moves across borders in a digital economy. When that narrative gains traction, it resonates not just with crypto enthusiasts, but with a much broader audience that includes businesses, financial institutions, and even governments exploring digital asset integration. However, it's critical to understand that rapid growth phases are rarely linear. Even in strong accumulation periods, markets experience volatility, corrections, and periods of consolidation. These movements are not necessarily signs of weakness. They are often part of the process through which markets establish new levels of support and resistance. What becomes increasingly important at this stage is understanding the psychological shift happening across the market, because when participation reaches a scale that is being described in the millions, the behavior of investors begins to change in a very specific way. Early hesitation turns into curiosity, curiosity turns into conviction, and conviction, when reinforced by visible momentum, can quickly evolve into aggressive accumulation. In the case of XRP, this kind of behavioral transition is particularly significant because it suggests that the asset is no longer being viewed solely as a speculative instrument, but as something that is beginning to carry broader financial expectations. At the same time, liquidity dynamics are becoming an essential part of the conversation. When large numbers of participants enter a market simultaneously, liquidity is no longer just a technical term. It becomes the foundation that determines how smoothly price discovery can occur. If liquidity is thin while demand is rising, price movements can become sharper and more volatile. If liquidity is strong and continuously replenished, the market can absorb demand more efficiently. What is being observed in XRP-related trading environments is an increasing depth in order books and more consistent participation across different timeframes, which suggests that this wave of interest is not isolated to a single group of traders, but spread across multiple layers of the market structure. Another layer to consider is the role of long-term positioning versus short-term speculation. Historically, when assets begin to attract widespread attention, a large portion of early inflows comes from short-term participants looking to capitalize on momentum. However, as narratives strengthen and confidence builds, a second wave often follows, this time consisting of longer-term holders who are less concerned with immediate price fluctuations and more focused on broader adoption trends. In XRP's case, this distinction is crucial because the asset's long-term thesis has always been tied to utility within cross-border payments and financial infrastructure, particularly through developments associated with Ripple Labs. Regulatory clarity continues to act as a silent but powerful driver in the background. Even without dramatic headlines, the evolving posture of institutions such as the U.S. Securities and Exchange Commission has already influenced market perception. Investors tend to price in uncertainty long before it is officially resolved and then reprice assets once clarity becomes more established. This process is not immediate, but it is persistent, and it often unfolds in stages. Each stage of reduced uncertainty tends to unlock a new layer of capital that was previously sitting on the sidelines. waiting for confirmation signals before entering the market. What is also becoming more visible is the expansion of global participation. XRP is no longer being discussed within isolated regional markets. Instead, it is being referenced across multiple financial ecosystems simultaneously. This global attention creates a compounding effect where awareness feeds participation and participation feeds further awareness. In digital asset markets, this type of feedback loop can be extremely powerful because it accelerates the speed at which narratives spread. Unlike traditional financial systems, where information flow is slower and more controlled, crypto markets react in real time to sentiment shifts, making momentum a critical factor in price behavior. Despite all of this momentum, it is still essential to recognize that markets do not move in straight lines. Even during strong accumulation phases, corrections are not only possible, but expected. The focus shifts from just participation numbers to the quality and persistence of that participation, because when an asset begins attracting sustained inflows across different cycles of buying behavior, it often signals that something deeper than short-term speculation is taking place. In the case of XRP, the ongoing accumulation narrative is being reinforced by multiple layers of market activity that suggest positioning is not random, but increasingly strategic. This is where the distinction between emotional buying and calculated entry becomes critical, because large-scale movements in financial markets are rarely driven by emotion alone when they persist over time. One of the clearest signals emerging in this environment is the shift in holding duration. When participants move from short-term trading behavior to longer holding periods, it indicates a growing level of conviction. This behavior is often measured indirectly through on-chain activity, where reduced velocity of tokens suggests that assets are being held rather than actively traded. In XRP's case, this trend aligns with the broader narrative of accumulation, where coins are gradually being removed from active circulation and stored in wallets that show minimal movement. This reduces immediate sell pressure and creates a structural environment where demand can begin to outweigh available supply more easily. At the same time, the influence of institutional perception is becoming increasingly relevant. While retail participation often drives attention spikes, institutional interest tends to determine whether those spikes evolve into sustained trends. The involvement of Ripple Labs in building real-world financial infrastructure continues to play a role in shaping how professional investors evaluate XRP's long-term potential. Unlike purely speculative assets, XRP carries a narrative tied to efficiency in cross-border transactions, which aligns with ongoing global financial modernization efforts. This positioning allows it to be considered within discussions that extend beyond crypto markets and into traditional financial systems. Another important factor is the evolving macro environment, where liquidity conditions across global markets influence risk appetite. In periods where capital becomes more willing to move into alternative assets, cryptocurrencies often benefit from increased inflows. XRP, due to its established history and recognizable utility case, tends to attract attention during such phases. However, what makes the current situation particularly notable is the scale of engagement being discussed, where millions of participants are allegedly entering or interacting with the asset simultaneously. Whether the exact figure is precise or estimated, the broader implication is clear: interest is expanding rapidly, and market awareness is reaching new levels. Regulatory sentiment continues to act as both a background influence and a forward-looking catalyst. The ongoing developments involving the U.S. Securities and Exchange Commission have already shaped market psychology in meaningful ways. Even partial clarity has historically been enough to shift sentiment from uncertainty to cautious optimism, and this transition often precedes increased capital inflow. Markets tend to price in future expectations rather than current realities, which means that perception alone can significantly influence behavior long before final outcomes are confirmed. As these forces converge, the structure of XRP's market activity begins to reflect a more mature phase of participation. Instead of isolated spikes driven by hype, there appears to be a layering of demand forming across different categories of investors. Retail interest brings visibility, while larger players bring stability, and together they create a more complex but potentially more sustainable growth environment. However, it is also important to recognize that this type of structure does not eliminate risk or volatility. Instead, it often redistributes it, meaning that while long-term trends may strengthen, short-term fluctuations can still remain sharp and unpredictable. Ultimately, what defines this stage is not certainty, but alignment of multiple independent signals pointing in the same general direction. When accumulation, sentiment, utility narrative, and regulatory evolution begin to move in parallel, the market enters a phase where attention intensifies and expectations begin to shift. It becomes necessary to step back and interpret what all of these converging signals actually mean when viewed as a complete picture, because isolated data points can be misleading. But sustained patterns across multiple dimensions often reveal the real direction of market sentiment, and the ongoing discussion around mass participation in XRP, including claims of millions of new buyers entering the ecosystem, should not be treated as a simple headline, but rather as a reflection of increasing market attention, liquidity rotation, and evolving investor psychology that is gradually reshaping how this asset is perceived globally. One of the most important conclusions from this broader trend is that XRP is no longer operating in a quiet or niche environment. Instead, it is positioned in a highly visible space where every movement, whether on-chain or off-chain, is amplified through global digital communication channels. This amplification effect means that sentiment cycles are becoming shorter but more intense, and reactions to news, speculation, or adoption signals are increasingly immediate. In such an environment, assets with strong narratives and real-world use cases tend to stand out, particularly when they are associated with established infrastructure development like that being pursued by Ripple Labs in the cross-border payments sector. However, it is equally important to understand that visibility does not automatically translate into guaranteed outcomes. Markets are complex systems influenced by liquidity, macroeconomic conditions, regulatory frameworks, and behavioral dynamics all at once. Even though interest in XRP appears to be rising significantly, sustained upward movement depends on continued participation, consistent demand, and the ability of the market to absorb both buying pressure and profit-taking cycles. This balance between demand and distribution is what ultimately determines whether momentum continues or pauses for consolidation. The regulatory environment remains one of the most influential background factors in this entire narrative. Developments involving the U.S. Securities and Exchange Commission have already demonstrated how legal clarity, or lack of it, can shape market behavior over extended periods. As uncertainty gradually reduces, capital that was previously waiting on the sidelines often begins to re-enter the market in phases rather than all at once. This staged re-entry creates waves of activity that can extend trends beyond what initial retail-driven momentum might achieve on its own. At the same time, the idea of widespread participation, whether it is 44 million users or another large-scale estimate, highlights a more important truth. XRP has entered a phase where it is part of mainstream financial conversation rather than isolated crypto speculation. This shift in narrative is significant because it changes who is paying attention. When retail investors, institutional observers, fintech developers, and global market analysts are all focusing on the same asset simultaneously, the level of scrutiny and engagement increases dramatically. That level of attention can act as both a catalyst for growth and a source of volatility, depending on how expectations evolve. What also cannot be ignored is the psychological dimension of this market phase. As more participants enter, fear of missing out tends to increase, but so does the sensitivity to price fluctuations. This creates an environment where momentum can accelerate quickly, but corrections can also feel sharper than expected. Understanding this dynamic is essential for interpreting any rapid changes in sentiment or price behavior. Markets driven by mass participation rarely move in a straight line. Instead, they move in waves that reflect shifts between optimism, hesitation, and renewed confidence. When considering the entire structure of this narrative, the key takeaway is not a guaranteed outcome, but a developing trend. XRP is positioned at the intersection of technological utility, regulatory evolution, and expanding global awareness. Whether this leads to sustained long-term growth or periodic cycles of expansion and correction will depend on how these forces continue to interact over time. For now, what can be observed is a market that is increasingly active, increasingly watched, and increasingly integrated into broader financial discussions. It is important to clearly state that this content is for informational and educational purposes only and should not be considered financial advice. Cryptocurrency markets are highly volatile and risky, and any investment decisions should be made after careful personal research and, if needed, consultation with a qualified financial advisor.